Did you know that nearly 60% of Americans don't have enough savings to cover a $1,000 emergency? It's shocking but true. Many people are underprepared for retirement, and even more are unsure how much money they actually need to retire comfortably. The traditional advice about how much to save for retirement is outdated and doesn't take into account the real challenges people face today. In 2025, the rules are changing. With rising inflation, unexpected medical costs, and an uncertain economy, the old retirement formulas just don't add up. The real question now isn't how much you should save, but how can you grow your money to retire comfortably while staying ahead of these financial challenges? In this video, we're diving into strategies that go beyond the typical retirement advice. We'll talk about using value investing to build wealth, how to make your money work harder, and why patience could be your greatest asset. By the end, you'll have a clear roadmap on how to use value investing to retire comfortably, no matter what life throws at you. Stay tuned, because the path to a stress-free retirement starts here. Chapter 1. The Retirement Puzzle. Can value investing fill the gaps? Retirement can feel like a complex puzzle. Many people wonder, how much money do I need to retire comfortably? Traditional retirement advice often says you need 25 times your annual expenses. But that number doesn't consider factors like inflation, market volatility, or changing life circumstances. This is where value investing can play a huge role. Value investing is about finding stocks and assets that are undervalued. By investing in them, you're setting yourself up for long-term growth. This strategy is ideal for retirement planning because it's focused on buying solid companies with strong fundamentals that can weather the ups and downs of the market. Warren Buffett, perhaps the most famous value investor, often says, the stock market is a device for transferring money from the impatient to the patient. By taking a patient, long-term approach to investing, you can watch your retirement savings grow steadily. And over time, the power of compounding will turn modest investments into a retirement nest egg. For example, imagine investing in undervalued stocks early in your career. If you consistently choose good companies at a discount, your investment could multiply significantly by the time you retire. According to historical data, the stock market has returned about 10% annually over the long term. Value investors often outperform this by choosing stocks with better growth potential at lower prices. In 2025, more people are questioning the old retirement rules. The cost of living is rising, inflation is unpredictable, and the traditional 4% withdrawal rule is being challenged. It's time to rethink retirement strategies. Value investing offers a way to build wealth that doesn't rely on uncertain stock market predictions or risky investments. It's about finding real value and sticking with it. The key is patience. Value investing is a long-term game, and retirement is a marathon, not a sprint. By finding undervalued companies with solid fundamentals, you can weather short-term volatility while watching your investment grow over the decades. It's a strategy that can lead to financial freedom and a comfortable retirement. Chapter 2. Decoding retirement numbers. How much is enough? When it comes to retirement, the question is often, how much is enough? It's a tough question because everyone's ideal retirement looks different. For some, it's traveling the world. For others, it's living quietly in a small town. But there's a more fundamental question to ask. How much do I need to live the life I want? Traditional advice tells you to multiply your annual expenses by 25. But this number doesn't account for inflation, unexpected costs, or changing life stages. You might need more or less, depending on your specific situation. To make better retirement decisions, it's important to factor in value investing. For example, let's say you're spending $50,000 a year. According to the 25x rule, you'd need $1.25 million to retire. But what if inflation averages 3% per year? That $50,000 will be worth less in the future. Value investing can help protect you from inflation because you're buying assets that increase in value over time, often outpacing inflation. A study by the National Bureau of Economic Research shows that retirees who use value investing principles in their portfolios tend to have more stable returns. By focusing on undervalued companies, you can build wealth over time, without relying on unpredictable market swings. This strategy works especially well if you start early and stay committed. Another interesting fact is that people often underestimate the cost of healthcare in retirement. According to Fidelity, the average 65-year-old couple will need around $300,000 for medical expenses in retirement. If you haven't factored this into your retirement plans, you could be underestimating the true cost of retiring comfortably. So, how much is enough? It's about balancing your lifestyle with solid, long-term investment strategies. A diversified value investing portfolio can provide the growth you need, while also cushioning you against inflation and other unexpected costs. By focusing on long-term value rather than quick wins, you can ensure that your retirement fund keeps up with your needs. Chapter 3. The 2025 Shift. Why traditional retirement calculators are outdated. Retirement calculators are a dime a dozen, but many of them are outdated. They use broad averages and simplistic assumptions, which often don't reflect the reality of today's economic conditions. In 2025, a more nuanced approach is needed to retire comfortably. That's where value investing comes in. Traditional calculators usually assume that your retirement savings will grow at a fixed rate, often 5% or 6%. But in a world of fluctuating interest rates, market corrections, and global uncertainty, that assumption is risky. Value investing offers a better way to grow your wealth by focusing on undervalued companies with strong long-term potential. Research shows that value stocks, which tend to have lower price-to-earnings ratios and higher dividends, often outperform growth stocks over the long term. This approach helps you create a more resilient retirement strategy. Instead of relying on generic calculators, you should focus on the quality of your investments. Let's take an example. Imagine two investors. One follows traditional growth investing, and the other focuses on value investing. Over a 30-year period, the value investor may have lower volatility in their portfolio, while also enjoying consistent returns. In the long run, this approach can outperform the stock market's average. According to Morningstar, value stocks have outperformed growth stocks by an average of 2% per year over the last 50 years. While this might not seem like much, the compounding effect can add up significantly. Over time, the value investor's portfolio can be worth substantially more than a growth-heavy one. This is why retirement calculators, which rely on broad assumptions and averages, often fall short. They fail to account for the benefits of value investing, which is about buying companies at a discount and holding onto them for the long term. In 2025, the key to retirement isn't just saving a fixed percentage of your income, it's about making smart, value-driven investment decisions. By focusing on value investing, you're setting yourself up for financial security. It's not about getting rich quickly, it's about building wealth steadily, even through market downturns. This strategy can help you retire comfortably, no matter what the market throws your way. If you're enjoying these insights, don't forget to hit the subscribe button. We'll be diving even deeper into strategies that can transform your retirement planning. Chapter 4. Underpriced assets and future-proofing your portfolio for retirement. The key to building wealth for retirement is often about buying assets that are undervalued today, but have the potential to grow over the long term. This is the core idea behind value investing. But how do you spot underpriced assets, and how can they help future-proof your retirement? Underpriced assets are those that are selling for less than their true value. When you invest in them, you're betting that the market will eventually recognize their worth. For retirement planning, this means choosing investments that will not only survive market fluctuations, but thrive over decades. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This quote captures the heart of value investing. It's not just about finding a bargain, it's about finding companies with strong fundamentals that are temporarily undervalued by the market. For example, many undervalued stocks come from industries that are currently out of favor. Perhaps a company has experienced a temporary downturn, but its core business model remains solid. By identifying these companies early, you can ride the wave of their recovery as they gain value over time. One fascinating statistic is that, according to Morningstar, value stocks have historically outperformed growth stocks by 2–3% annually over a 20-year period. This consistent outperformance makes value investing a great strategy for those aiming for long-term growth. These returns may not always be as flashy, but they add up over time, perfect for retirement planning. In addition to stocks, consider real estate. Real estate is often undervalued during economic downturns but can offer excellent returns in the long run. Many investors who focus on value have found great success in buying properties at a discount, renting them out, and watching their investment appreciate over time. Another way to future-proof your portfolio is by looking for companies with strong, recession-proof business models. These are companies that have essential products or services that remain in demand no matter what the economy does. Companies in industries like healthcare, utilities, and consumer staples often fall into this category. By investing in these types of assets, you're building a resilient portfolio that can weather economic storms. A key part of future-proofing is staying patient. The market tends to fluctuate, but solid, undervalued assets will often rise over time as their true value is realized. By sticking with your value investing strategy, you'll ensure that your portfolio grows steadily, providing the foundation for a comfortable retirement. Chapter 5. The Magic of Compounding, Retirement's Best Friend. If you've ever heard the term, compounding, you know that it's one of the most powerful forces in investing. It's often referred to as the eighth wonder of the world, and for good reason. The magic of compounding is exactly what can turn small investments into massive retirement savings over time. At its core, compounding means earning returns on both your original investment and the interest or dividends your investment generates. Over time, these compounded returns snowball, creating exponential growth in your portfolio. The earlier you start, the more you'll benefit. Albert Einstein famously said, "Compound interest is the most powerful force in the universe." That's not just a catchy quote, it's a fundamental truth for value investors. The key to using compounding to your advantage is reinvesting the dividends and gains from your investments, allowing your wealth to grow exponentially. Let's consider an example. If you invest $10,000 at an average annual return of 8%, you'll have around $21,589 in 10 years. After 20 years, that amount will grow to nearly $46,610. But if you continue to reinvest, that $10,000 could turn into over $100,000 by the time you retire. The difference is all thanks to compounding. But compounding isn't just about choosing any investment. Value investing plays a key role here. When you buy undervalued companies, you're giving your money the chance to grow faster than by simply relying on broader market averages. And by focusing on companies with strong dividends, you can further turbocharge your compounding strategy. According to NerdWallet, reinvesting dividends can boost your returns by 2% or more annually. Over decades, that extra 2% can mean the difference between retiring with $1 million or $2 million. Value investing helps you identify the best companies to benefit from compounding. By choosing companies with strong growth potential and reliable dividends, you're setting up a snowball effect of wealth creation that will fuel your retirement. The beauty of this strategy is that it doesn't require you to do much once the investments are in place. Patience is key. The earlier you start investing, the more time you have to take advantage of compounding. Even small contributions early on can lead to huge gains later. If you're in your 20s or 30s, compounding will work even more magic on your retirement plan. But it's never too late. Starting now, even if you're in your 40s or 50s, will still make a significant difference. Chapter 6. Retirement Strategy 2025. Building Wealth with Patience and Precision. In 2025, retirement planning requires a different approach than in the past. With the rise of inflation, global economic shifts, and the unpredictability of markets, traditional strategies may not cut it. That's why building wealth with a patient and precise value investing strategy is more important than ever. Building wealth for retirement isn't about quick wins. It's about being patient, staying disciplined, and letting time do the heavy lifting. Value investing is built on this principle: buying great companies at a discount and holding on to them until their true value is recognized. The patient approach pays off in the long run. The key to this strategy is precision. You can't just invest in anything that looks cheap. You need to understand the company's fundamentals and its potential for future growth. This means researching financials, management, and the company's position within its industry. Precision ensures you don't end up with assets that are undervalued for a reason. Let's look at data. A study by Fama and French found that value stocks outperformed growth stocks by an average of 3% annually over 50 years. These consistent returns show the power of precision investing. By picking undervalued companies with strong financials, you're setting yourself up for steady growth over time. In 2025, with the market still adjusting to post-pandemic realities, the patient investor has an edge. Many companies are undervalued due to short-term volatility, but with careful analysis, you can buy them at the right time. The key is recognizing when a company is temporarily undervalued and not letting market noise distract you from long-term goals. One of the most powerful tools in value investing is the ability to see beyond market sentiment. Markets tend to overreact, causing stocks to be underpriced in the short term. By focusing on the fundamentals of a business, you can ignore the noise and focus on long-term growth. A great example of this is the rise of the tech sector. Companies like Apple and Amazon were undervalued in their early years. Investors who recognized their potential and invested patiently saw massive returns. The same principles apply today to companies in sectors like renewable energy, biotechnology, and e-commerce. By taking a precise approach to your investments, you're not just hoping for a good return, you're actively choosing investments that align with your retirement goals. This strategy ensures that your retirement portfolio isn't just built on chance. It's a calculated approach that maximizes growth while minimizing risk. The bottom line is this: in 2025, retirement success depends on patience and precision. By focusing on undervalued assets and holding them for the long term, you're giving yourself the best chance to retire comfortably and on your own terms. Keep your eye on the prize, and let value investing guide you to a secure future. If you've found these tips helpful, don't forget to subscribe. You'll get more actionable strategies to help you retire with peace of mind.